Thank you for joining us. It's a great pleasure to have with us Timothy Vick, Senior Portfolio Manager at Sanibel Captiva Trust.
Well, it's
Timothy,
my pleasure, Oliver.
welcome.
Thank you very much.
Such a pleasure to have you on the program today. We are here in Omaha, and I'd love to get your thoughts on the Berkshire meeting. Of course, you've followed Warren Buffett for a long time. You've written 3 wonderful books, including the best-selling How to Pick Stocks like Warren Buffett. So it'd be really interesting to hear your thoughts on this year's annual meeting.
Well, Oliver, I've been coming to Berkshire meetings for about 14 years now. And I got to say, I look for something different out of every meeting. But over the last 5 or 6 years, the most crucial elements to me have been succession. And we've been looking for clues. One, how has Warren Buffett been doing health-wise? Because we knew that a few years ago his health was an issue, and it got us all worried about, how much longer, can he sustain the business model? How much longer is he going to be at the helm of Berkshire Hathaway, and who can replace him? So the last 4 or 5 years, these meetings to me have focused on this issue of succession and whether or not Berkshire can carry on without Buffett. And this year, I would say we got the best answers, ever for that shareholders can take home and say, I'm really comfortable, this company's in good hands, it's going to stay in good hands for a long time after Buffett's gone.
And what made you conclude that?
Well, there was a range of questions, and they're coming from shareholders who, in my opinion, have they've grown up near and dear to Warren. Many of them have their entire net worth, or a good portion of their net worth, in Berkshire stock. And not only did the stock hit an all-time high just a couple days ago, but their net worth probably went to an all-time high too. And I was putting myself in their shoes of someone who's 60, 70, maybe even 80 years old, whose net worth has just flourished under Buffett. The first thing they've got to be thinking about right now is not going backward and making sure that their net worth doesn't suddenly collapse, that there's nothing under the table of Berkshire Hathaway that can go wrong and cause their stock and their net worth to drop significantly. And this is a typical reaction to someone who's elderly, who's built up a substantial fortune. You just don't want to lose it anymore. So I can see a lot of Berkshire shareholders coming to the meeting this year specifically needing reassurances that this company had staying power. That beyond Buffett, there was a deep bench of managers, there was a board that was going to carry on the culture of Berkshire Hathaway, that Berkshire could essentially run itself for the next several years. And then we had questions along that line. How is Ajit Jain going to stay there? How strong is Howard Buffett's credentials to be a board member? Is there a deep bench of talent running these companies that's not going to defect after Buffett's gone? Is Charlie Munger going to still be around? Is there going to be deal flow? Are there going to be companies calling Berkshire Hathaway out of the blue saying, I would like to sell to you? Those types of questions is what has been on a lot of our minds. And this year, Charlie and Warren took all these questions on, answered them very consistently, and I think gave us really good answers that would tell me that Berkshire's on cruise control. And that's the most satisfying piece of data that I could get as a shareholder this year, that this company could survive, if Buffett passed tomorrow, or if Munger passed the day after tomorrow, that this company will run itself for a number of years. It may not grow at very high rates in the future. It's certainly not going to grow at the rate it grew 20 years ago, but it can grow at satisfactory rates for shareholders. They don't have to worry about the stock suddenly plunging on them because Berkshire has put in a nice buyback plan that will initiate if the stock suddenly plunged to a near book value or a little premium to book value. So Buffett has put in that last kind of cushion for them. And I walked away from the meeting, and I think a lot of elderly shareholders walked away knowing this company is going to be in safe hands and we don't have to worry anymore.
And what has perhaps impressed you or surprised you with the tone and the interaction between Warren and Charlie at the meeting? You said you've been visiting here for 15 years about. Can you tell us a bit about how perhaps the interaction between Warren and Charlie has changed over the years, and what you can conclude from that?
The interaction between them has always been one that displays a deep friendship and a deep respect for each other. And they've always been kind of foils to one another in some respects, not only politically from where they stand that way, and it's starting to come out more in the last couple of years exactly what their politics are. And I think as they get more elderly and on in years, they would like to tell the world more about what their political views are. They had to stay silent for many years. But in terms of just being good foils for each other and also knowing what their role is in the meeting, this is still Warren's show. Warren needs to be doing 90 to 95% of the discussing. Charlie is there to add and interject, his personal feelings on matters. And Charlie is certainly of equal caliber when it comes to intelligence, if not, more worldly wise than Buffett in terms of the types of subjects he studies, and he can interject on about any subject. But I think he just sits back and lets Warren take over the questions, and if it's passed to him, if he's got something to add, he's going to add it, and he's going to do it in his blunt kind of style that we've come to characterize and know Charlie, to display for us. And it's not only good comedy to watch these two interact, but they do it in a way that they supplement each other in terms of the types of information they give us. So as they've evolved over the years, shareholders have evolved with them, and then we understand always where they're coming from. And we've gotten to the point that when a question's asked, you can almost know in advance how Charlie and Warren are going to answer the question. You never know what tangents they're going to go off on, but you know how they're going to answer it because their thought process is so consistent. And as a long-term shareholder of Berkshire, I like to see that consistency in thought process. I'd like to see that they're answering questions and thinking about these questions in the same way they were thinking about them in 1980 and in 1970 and 1960, and they do perfectly.
When we come to some of the issues that were discussed at the meeting, what are your key takeaways there? What sort of stuck out to you in terms of just the various topics that are addressed at the meeting?
Well, we used to have a lot of personal questions about investing, like young kids would come to the microphone and say, how would I start out? Those types of questions have kind of washed away. We're getting a lot more specific questions about the operations, through the analysts and the journalists, I think, have screened the questions very well. So we're getting a nice, I think, gamut of questions that shareholders should be asking of their CEO. Not so much kind of the groupthink questions where everything's wonderful, thank you for managing our money for all these years. Basically, how are your insurance businesses doing? Why aren't we in these types of markets? There's a few questions yesterday about Geico possibly losing competitive advantage to Progressive because Progressive has rolled out this new snapshot type of data mining system. Those are kind of hardcore questions that I think shareholders should be asking of their CEO, and maybe this reflects in some respect a turnover of the shareholder base, that you now have a lot more professional money managers actively involved in Berkshire Hathaway. You've got a lot of younger Turks, let's say, of shareholders coming from all over the world who are not afraid to ask hard questions of Warren and Charlie because they've only been involved with the shares maybe a few years and they haven't enjoyed the riches that the 60 and 70 and 80-year-olds have. So they have a little different perspective. They're going to be a little more hard-hitting. And I've enjoyed it as a money manager, just sitting back and listening to the hard-hitting questions being asked of Warren and Charlie, and to see that they're up to the responses. They don't shy away from any topic, as you know. So it's very informative, a lot more informative the last couple of years than I've seen.
What do you think then for Berkshire shareholders, some of these more professional or younger ones who haven't enjoyed the riches and the value creation over the last few decades, what are perhaps the key issues that they should be focused on now?
They need to be focused on how fast can this company continue to grow. Charlie has been very blunt on that issue, that Berkshire is not a company that can grow at 15 and 20% rates in terms of book value growth in the future. We know that. We just look at their balance sheet. We know they're just too big to grow at those types of rates. But we want a company that at least can grow much faster than GDP, whether it's world GDP or US GDP. We certainly want a company that's exemplary for the insurance industry, that can outdo the insurance underwriters that it competes with. And we want companies that, when you look at them on a conglomerate basis, can grow faster than their typical conglomerate, like a General Electric or a Siemens or a company like that. Now, I think Berkshire Hathaway can pass muster on all those types of tests. So if you're looking at that and you understand that Berkshire is still going to be a very solidly run company, even at a market cap of $260 billion, it still has the ability to grow. That should be attractive enough for money managers to want to hold this in portfolios. Now, is this an aggressive stock or an aggressive company as it was 30 years ago? No. It would have a different type of place in portfolios. So a money manager like myself, who might be putting Berkshire Hathaway in portfolios, is going to think of it as more a steady growing company and not something that's going to hit the ball out of the park. Now, the younger managers who show up from all over the world, I think, also want to get a taste of Warren and Charlie, because he's Oz to all of us. You know, he's the wizard. He's the person you want to see, at least have a chance to see and listen to him before he passes on, or before, we have a changeover in management there. Because once he's gone, we have nothing to hang our hats on anymore except his past words and his sayings. And of course, that'll be written and diagnosed to death, I think, over the next 30 or 40 years. But if you still have a chance to come to one annual meeting, and it only costs one B share to do it, I would say do it. And I think this message is being delivered loud and clear around the world. This is why we have so many young investors coming from Asia, from India, from Europe, from Canada, from South Africa. They want to hear him before he passes on.
Now, to come back to what you said about the different role that Berkshire can play in people's portfolios, and also the growth prospects there, tell us a bit about how you then see it within the context of your portfolio, and what are some of the thoughts that you go through when you think about businesses like Berkshire that may be out there, and the alternatives to as investments?
Well, as I look at Berkshire, I see a compounding machine. And that's how we have to think of it historically, we have to think about it today, and we have to think about it or its replacements in the future. Can it compound value? Because naturally that is the best course of action for any sort of portfolio and a portfolio manager. You certainly don't want to put stagnant stocks in portfolios. You want companies that grow, because growth, of course, leads to increased business values, which is going to pull up share price over time. And of course, the faster that growth is, the faster the share price is going to appreciate. So we got to think about a company like Berkshire as, what is its ability to grow in the future, and can we get it at a decent price? One of the things we look at, fundamentally with Berkshire is what's its true value. And there's been a lot of discourse on that. Analysts of all sizes and shapes over the last 10 or 15 years have tried to throw out models for how you value Berkshire. To me, it's very simple. You just assume that you could buy this company, take it private yourself, and figure out what you would pay for it. And you start with the operating businesses. They throw off X amount of cash flow per year, $12, $14 billion a year. You give that a multiple, which tells you the operating businesses are worth, let's say $120 billion a year, or $120 billion of intrinsic value. And then if you were to buy Berkshire Hathaway and get those operating businesses, you get all the free stuff on the side. The stocks, the bonds, the cash that's on the portfolio. Now if you take all that and subtract out the bonds that need to be held back as insurance reserves to pay the claims, and then you hold back some of the cash to pay the taxes, assuming you would liquidate that stock portfolio, you still have a tremendous amount of unencumbered cash and stocks and bonds that are on that portfolio that you would get for free buying the company. And if I'm a buyer of the company, I would put a multiple on those operating businesses, and let's say that's $120 billion is what I'd pay for the railroad and Geico and all the other businesses. And then plus, on top of that, I get another $120 billion of unencumbered stocks and bonds. That gives me my valuation. So as we look at Berkshire right now, we value it at approximately $260 billion a share, or $260 billion on an intrinsic value, and that's right about where the stock is trading. So we think Berkshire, after this phenomenal run in the price over the last 18 months, has finally pulled up to fair value. So now we can diagnose it from that point of view, and then we look at the metrics and say, how fast can this company grow? Berkshire can possibly grow at GDP plus a couple percentage points because of the type of conglomerate it is. It's still a compounding machine, not the fabulous machine it was in the past, but because of its size now, we still think it can grow a couple percentage points faster than GDP. And now that it's fairly valued, that kind of gives us a sense of how much the share price can appreciate. Not counting a potential dividend in the future, but Berkshire stock can probably give us a 6 to 8% return from these types of price levels, and then we back that up and determine, is that appropriate for most clients? And if a 6 to 8% type grower belongs in a portfolio, it's going to be put in there.
Well, let me actually ask you on that note about the nature of the businesses that Berkshire now has, and certainly over the years the importance of the wholly owned businesses has increased, and they are really in regulated capital-intensive industries. That's sometimes forgotten, and in this year's annual letter, there was a statement along the lines of we place trust into the future regulation, indicating perhaps that, well, it could change,
Right.
and how that could impact these businesses. Is that perhaps an area that deserves more attention, or how do you view that in a way? The prospects for the key businesses at Berkshire, what would you say is the biggest risk there, and could it perhaps stem from regulation?
Well, regulation is now going to be a much larger risk than it ever was in the company. And this gets to the issue that Buffett has raised many times in the past, where he's talked about the perfect business is one that doesn't require a lot of capital. That you can take all the retained earnings and put it in something else, or put it right back in the business without a lot of maintenance spending. And suddenly here he is buying a railroad, and he's got Mid-American Energy, and now he's bragging in his annual reports about how much their CapEx is every year. Well, they're getting decent returns on the retained earnings and decent returns on their CapEx, those particular businesses, even though they are regulated, particularly Mid-American Energy, that we don't quite worry about it as much. And this is also an evolution of Buffett's painting of Berkshire Hathaway. He can't do the same things he did 20 years ago in terms of adding new companies and finding those great compounding machines. He has to settle, and I use the word settle very literally, you have to settle on companies like Burlington Northern to put in the portfolio and use those to provide more steady returns for shareholders. This is kind of an acknowledgement on Buffett's part that Berkshire can't grow as fast, and he doesn't want it to grow as fast. He doesn't want it to be a very volatile company in the future. And this gets back to this idea of protecting his older shareholders and giving them a company that's not going to give them the business risks that we might have been accustomed to when Berkshire was more cyclical, more growth-oriented, didn't have the capital requirements, and flushed out a lot of cash for a new manager to put to use. By virtue of the fact that Burlington and Mid-America now use up so much internal capital, that's less that the next CEO is going to have to worry about. And these companies are doing it very effectively. Burlington Northern is getting a pretty high return on its invested capital right now. And as you know, the railroad industry has shrunk dramatically over the last 20 or 30 years. We're now down to 7 Class 1 railroads, and between them they control more than 90% of the rolling stock of the track in the United States. So it's forming its own little oligopoly where everybody can return their cost of capital. And this is what makes Burlington Northern a very pleasing addition to the portfolio, because now we know that Burlington's going to churn out a lot of profits and put some of that back into CapEx, and I think very safely put it back into CapEx because of the because of the condition of the industry right now. In fact, we're down to 7 competitors. Every one of them can make a profit on their CapEx that they're redeploying in the business. So it's more of a safety aspect, I think, that because these big chunks of the portfolio now require the CapEx within Berkshire Hathaway, that we don't have to worry about the next manager having too much capital and to spray it around in a lot of maybe dubious investments in the future.
And certainly it's an interesting point about if Berkshire is now more of a steady grower, yet with the new leader coming in, often they would want to assert themselves through let's say growth or some more aggressive actions, but that is really the opposite of what Berkshire needs at the moment, given its size. So in a way, what do you take from that, if one can assume that, in terms of the nature of the successor?
Well, we don't have to worry about the successor now, because Buffett has taken care of it for us. By virtue of the fact that he's spent a lot of money on large acquisitions the last 3 or 4 years, he has pretty much filled up a good part of the balance sheet, that there's really very little that the successor can mess up. And I think he's looking at the company from this point of view, that I don't want the new successor come in trying to reinvent the wheel, find new investments that I couldn't find over my 50-year period. But basically, I'm going to give the successor enough money so they can move the needle a little bit, but not move the needle a lot on Berkshire. And again, this comes back to the issue that I think he's still thinking about his long-term shareholders and protecting them. He wants to make sure that not only is Berkshire still going to be a growing company, he's got the the horses in the stable right now that can ensure that Berkshire is going to be a growing company, but it's not going to be a fast grower, but it's not going to be a slow grower either. It's going to be a very more steady company than perhaps some of the shareholders have been accustomed to in the past. And he's also ensured that whoever follows him can't really mess up this company. And this is really an exquisite formula. You know, if you're running and building a business and you're thinking about how it's going to form and develop and evolve after you die, there aren't too many models where the leader dies, a long-term leader, and the company sustains itself, you know, through evolutions of leaders. But, you know, Berkshire looks like it's setting up that way. He's following the footsteps of Standard Oil, John Rockefeller. Rockefeller was kicked out of that company, I think, or left it in 1897, 116 years ago. And that company was the largest company in the world at the time. I think they were doing about $100 million in operating profits. And it broke itself up into, I think, 28 or 29 pieces around 1913. And those pieces have come back together, and it's now ExxonMobil. Here we got ExxonMobil, 116 years later, is again one of the largest companies in the world. They've had a succession of boards, a succession of CEOs and chief operating officers and CFOs, and they put themselves in far-flung projects around the world, but it sustained itself. Rockefeller did something right, putting this painting of his together so it could survive long after him, and I think Berkshire's kind of following that type of model.
Now, as investors, we can certainly be much more opportunistic and in the ways that we select investments, and you mentioned some of the imperatives perhaps for Warren Buffett in the way he's gone about selecting investments for Berkshire, and as a result what that has meant for the nature of Berkshire as an investment. So when we look at just the whole world, how do you assess companies that perhaps exhibit some of these characteristics that Berkshire exhibits, but perhaps maybe better vehicles for you as an investor?
Well, we love these vehicles. This is why so many money managers and CEOs come to Berkshire, because they're trying to find ways to model themselves or pattern themselves after Berkshire Hathaway. And why not? Because you've essentially built a publicly traded private equity company or a hedge fund, you know, that's publicly traded, but you also have this beautiful model that your gains are going to equal Warren Buffett's gains or the CEO's gains. They're not going to make any extra money more than you because they own big blocks of stock, and the cost to enter into this partnership with them is only the commission on the shares, you know, a penny per share, 2 pennies per share. That's all it costs to participate with Buffett. You get the same returns he does, and I think shareholders are coming around to this idea of latching on to companies that can compound, where the owners or the founders or the folks who really developed this model are still around, can have a wide gamut of investments all around the world to put the money into, and you can earn the same returns as them, even though you're essentially in a private equity vehicle. Because if you understand Berkshire as a private equity machine, and you realize that one of its secret sauces is the ability to just take money that comes from insurance flow and put it anywhere in the world, you've got a dynamite combination there. If it's done right, if it's done with discipline, if it's done with temperament and rationality, and you don't have CEOs with large egos, this is something that can sustain itself, because this idea of being able to just go outside of your industry and put the money anywhere. It could be in a private equity venture in Australia, it could be in the United States, it could be a large cap, a small cap, it could be a cement company, it could be a tool and die company. You know, how many companies have that kind of flexibility? If you're General Motors, you take your excess capital, you got to put it back into your plant and build more cars. You can't just start making nylon stockings with that money. You got to keep building cars. Berkshire Hathaway, along with some other companies that are trying to copycat it, can take that money and put it anywhere in the world or not deploy it. There's no institutional imperative on them to constantly be fully invested with the cash. They wait for opportunities. They have that discipline that says, when I can get a 10 or 12% internal rate of return on my cash, I'm going to deploy it. I'm going to scour the world, and that gives me the flexibility that no other company has. And if I do it with discipline, I'm going to grow book value at very nice rates. So we like looking at these types of Berkshire lookalikes, so to speak, to see if we can find companies that can sustain what Berkshire has sustained over a long period of time, but carry us into the future, because we know that Berkshire is slowing down.
Well, let's talk a little bit more about these Berkshire lookalikes. What have you found out there that has caught your interest?
Well, one of my favorite companies, and we've been invested in it for a number of years, is Markel Corporation. This is a Virginia-based property and casualty company. It was started in the 1930s by the Markel family. I believe there were 4 brothers, 2 sets of twins who started it and carried it on. We're now into the 3rd and 4th generation of Markel family members who are running it. And it's been a little niche insurance company. They insure everything from summer camps to museum art exhibits to malpractice insurance for doctors up to big things like oil rigs and derricks and marine and transportation type of insurance. But they've employed a successful underwriting discipline over a long period of time since they went public. I think I counted that their combined ratios averages around 98%, so that there is no cost to float there. Like Berkshire Hathaway, they get free float every year to the tune of a couple percentage points, and then they take that float and reinvest it in stocks and bonds, and in the last few years into private equity investments. They were buying whole companies outright. They've now got, I think, 11 or 12 of them under the fold. And this is a company that is under the radar screen. They only have about 10 million shares outstanding. So the market cap right now is about $5 billion. And they went public in the mid-'80s, and the stock has gone up 100-fold over that time. And they built book value at around 19% annual rates. And this is just a beautiful compounding machine, and they got all their guidance, I think, from Warren Buffett, because they've been coming to Berkshire Hathaway annual meetings for about 23, 24 years now. Their shareholder base is very similar to Berkshire's shareholder base. There's a lot of crossover. There's just a lot of combined DNA between Berkshire and Markel.
Now, let's talk a little bit about perhaps some of the differences that you see between Markel and Berkshire, leaving aside the obvious one, size, perhaps in terms of just the personalities involved, and perhaps to give us a flavor for also how difficult it is to be a Berkshire lookalike, and perhaps then also what are the opportunities on the other hand that these more nimble players can take advantage of.
Well, I don't know if you can ever duplicate Berkshire Hathaway, because to do that you have to duplicate Charlie and Warren, which means you have to go back and create someone back in the 1930s or 1940s and wire them the same way those guys were wired back then, because all their ability to find excess value in the market comes from the way they were wired 40 and 50 years ago. So you just can't create a new Warren Buffett today. And a lot of people think they can, but what I like about folks like Markel is they do it on their own terms, as everyone does. And even you think about comedians. No 2 comedians are alike. They may study, the previous generation of comedians, but they know in order to be successful, they have to get and fit within their own skin and do what comes natural to them, and they evolve, and they have their own characteristics that makes them different from any other comedian, and that's why they're all unique and different, but they can all be successful. And I think when you're trying to duplicate a Berkshire model, if you apply it strictly, it's going to be very difficult to duplicate, because you're trying to replicate what Warren and Charlie have wired inside their skin. But what a company like Markel can do is, first, they're niche insurance businesses, types of businesses that a lot of insurance companies don't even want to get into. So there is a little bit of pricing power from time to time. Not only that, they have just a strong underwriting discipline of not losing money. And I can tell that when you look at their reports, if we get into a soft market where prices are coming down from insurance, they don't ramp up the premiums, the volume, just to improve revenues that way. If anything, they draw back. And that's what I like to see with an insurance company. And Berkshire Hathaway has shown the same tendencies with the G chain, that when markets get soft and prices aren't correct, you just don't write the business, and you let it drift away, and you let your premiums suffer, and you let your operating profits suffer for a while, which means your combined ratios go up, but that's showing discipline. And when the markets get hard and you got a lot of excess capital, you go in there and you ramp up your premium volumes, you raise them 20-30%, and it really helps your bottom line for a couple of years. But you have to show that underwriting discipline first and foremost, because in the insurance business, if you don't have underwriting profits every year, you've got no float to invest. Then you're more susceptible to market fluctuations. You don't get that free 2% yield that you want on that portfolio. So Markel's got that secret sauce baked into them. A lot of it's cultural. A lot of it's the fact that I think personally that they're not a New York-based company. They're not from Miami. They're not from San Francisco. They're not from the big centers. They're Virginia-based folks. They have a very good discipline. They just have a very good way of looking at things, and it's divorced from the business cultures of the major East Coast cities. They're based out of suburban Richmond, Virginia, and they bring with them just a way of looking at things that is more conducive to discipline and value orientation than you're going to find in a lot of insurance companies. So you combine their culture and their steeped history and the fact that you still have family members running the company who are major shareholders of it, and then you have the operating discipline within the insurance company, and then you add on top of that, with all these factors going for them already, you add on top of that the fact that their portfolio selections have been exemplary. I mean, Tom Gaynor, as a CIO of Markel, has been beating the S&P 500 quite handily now for almost 2 decades, and that has allowed the compounding of the book value. So they've got a lot of interesting characteristics. They're doing it their own way in niche insurance companies. They are following the discipline of building a business model like Berkshire Hathaway, but they're not trying to duplicate Charlie and Warren personality-wise.
What are you most excited about when it comes to the opportunities that are available to Markel to really, that runway that they have as opposed to, let's say, a Berkshire Hathaway? What opportunities are you most excited about?
Well, one of it is size. You've got to think about Markel as a Berkshire Hathaway of the late 70s or early 80s. You have to go that far back to get to Berkshire Hathaway being the size of what Markel is now. So that runway is still very long, and it's still in front of them, not behind them. And that size means that they can just continue to compound and build competitive advantages in their market and steal market share at decent rates. And as the markets fluctuate up and down, the insurance markets, they'll be able to dabble in and find ways to just keep increasing book value at very strong rates. They also have just completed a merger with a competitor called Altera, which is going to get them into reinsurance, but also a little overlap with some of their niche insurance businesses. And right away, this is going to be accretive to their book value, but it's also going to be accretive to their book value growth because they're inheriting a stock and bond portfolio from Altera that's mostly mostly bonds, whereas Markel is more of a 60-40 mix. So Tom Gaynor at Markel is going to try to take that Altera portfolio to about a 60-40 mix, which will give him, several $100 million of stock opportunities that he can, of money that he can put to work for Markel to accelerate the book value growth that he naturally would have gotten or Altera would have gotten on their own. So there's an opportunity right now to just have a few $100 extra million at their disposal to put anywhere. And I think they're going to try to build up their Markel Ventures more. Like I said, they've acquired 11 or 12 companies now in their private equity ventures. These have turned out to be smashing successes for them. They've gotten 2 and 3 baggers on a few of these companies already. These are private companies, smaller, sometimes $50, $60 million worth of sales. But in general, they're getting good results, and we're going to see more of this. And this is akin to what Berkshire was doing in the 1970s, with See's Candies types of acquisitions. Smaller companies maybe only had $25 or $30 million in sales at the time, but you deployed it at a right price, and you let these companies flower, and you just let the managers run them, and you wake up 20 years later, and these companies are producing 20 times the sales they were, and then you've got a smashing home run. So we're looking forward out of Markel to a decade or 2 from now, some of these companies they've just bought into really flourishing and starting to add meaningful amounts to the book value growth and to the bottom line.
You described how you assess the valuation of Berkshire Hathaway and sort of what reasonable expectations investors should have in terms of the return going forward. How do you see that with Markel?
I would look at their capability of improving book value, because ultimately you want to look at some of these insurers as how do you price them relative to their book value. Do they stay are they worth a premium? Are they worth just book value or under? Markel, with their balance sheet and knowing what they can do in terms of growing their insurance markets and just thinking about the opportunities that are going to be available with the float over time, I still think can grow their book value at double-digit rates. Maybe not 19% like they've done since the mid-'80s, but I would take anything over 12 to 15% would be just satisfactory perfectly satisfactory to me, because that means that you can look forward to a share price compounding at about that rate as well. Keep holding the price to book value constant. And Markel themselves have made comments that they think their stock could or should be worth closer to 2 times book. And I'm not that optimistic. I'd love to see 2 times book and sustained over time, but I would take a 1.3 times book And if they were to maintain that and grew their book value at 12 to 15% a year, I think we'd do just fine with that company.
So that seems to indicate perhaps twice the rate of return of a Berkshire.
Oh, absolutely. And again, I think it comes down to the size of the company. Think of Markel as Berkshire Hathaway from 25 years ago in terms of size and runway, what's in front of it. And unfortunately with Berkshire, we're almost at the near the end of the runway.
Now, I really want to ask you one question that relates to both Berkshire as well as Markel, just this record low interest rate environment and for insurance type businesses, and Warren Buffett has spoken in the letter this year about the wasting assets, and how do you see that relating to the insurance businesses at Markel and Berkshire? If interest rates were to go back up, how does that affect these businesses?
I think this is the chief concern that they all have, that the interest rate environment we see right now is artificially low, maintained by the Federal Reserve and being pushed lower by stimulus efforts passed all around the world. And they all worry, and you can see their worry in the way they structure their stock and bond portfolios. They worry that rates have to go up at some point in the future. And they are already starting to protect themselves. One thing you can do as an insurer, you get rid of your bond portfolio, or you start really cutting back the duration or shortening it as much as you can, even to the point where you're holding a lot of cash. Even though you're not going to get any return on that cash, it's better than watching your bond portfolio erode in value as interest rates go up. And we've seen it with Berkshire Hathaway, we're seeing this with Markel. Both of them have really curtailed their purchases of treasury bonds. Markel, I think, is only holding about $300 million of treasuries right now on a multi-billion-dollar portfolio, within their bonds. And they've also brought the duration of their portfolio down to about 2.5. And that is, I think, the lowest Markel's ever been, since they've been a publicly traded company. They try to average somewhere in the 3 to 5, more to 4 to 5 range on duration to match their liabilities, to their assets, and to make sure the duration of their bonds pretty much matches the duration of the insurance liabilities and the payouts on the claims. But they're not doing that right now. They are worried about inflation bubbling up. They don't want to see erosion of the bond portfolio in terms of value. So they've got a portfolio that's more and more gravitating and looking like it's a cash portfolio. And I'm talking to Tom Gaynor yesterday about it, and he was talking to shareholders again this morning. This is not something. They understand they are in an unusual situation. It's unprecedented, like Warren Buffett said, to have interest rates push down this low and stay low this long. We're in uncharted territory. You got to protect yourself. And right now, if you're an opportunistic type of investor, you would rather hold cash earning nothing than try to put it to work to get 1% or 1.7 and take risks of principal erosion. Because that risk right now is much worse than the yield is. You are buying into, if you're buying 10-year treasuries, you're lending money to our government at 1.6%, and you can lose a lot more of that in terms of price depreciation if we start having inflation. So you get a negative real return on these bonds. I think they're all looking at it from that point of view. They would rather hold cash and sit on it for a year or two, knowing that when they do deploy it, they hope to get yields or returns much higher than 5%, maybe closer to 8 or 9%. And that's much better than holding cash or holding bonds that's going to pose some risks to them. So we're seeing these insurance companies, and not just Markel and Berkshire, but others, taking this move in their bond portfolios away from treasuries, more cash. They're holding corporate bonds, they're holding municipals just to get a little more relative yield. They're holding some foreign bonds, but generally they're slowing down their lending to government in general, and they are protecting against inflation, and they are assuming that inflation is going to bubble up at some point.
So then if there is an increase in interest rates in a way that would make it easier for these companies to earn more money, so it could be a positive, this sort of hidden positive impact on the business.
Oh, it does, but in the interim, before that happens, if our interest rates go from 2% to 4%, that's great if you're deploying new money. If you're already holding things at 2%, bonds that are 2%, and the interest rates go up to 4%, you're going to suffer drastically on the price of these bonds. And they're trying to protect against that. But I think anyone in the industry right now can't wait for be able to get 4, 5, even 6% yields on treasuries like we used to, I think they would lock it in. But we're not there yet, and they're going to wait patiently until we get that, because the worst thing that can happen, or one of the worst things that can happen to an insurance company, is the bond portfolio just erode in value. The last couple of years, they've had to start doing mark-to-market financial accounting of their bond portfolios and their stock portfolios every quarter, and this does not have the nicest impact on insurance balance sheets, particularly when interest rates are rising and falling, because suddenly you're mark-to-market your bonds at lower prices, you start eroding your book value. And a lot of insurance companies, the chief asset they own are bonds. That comprises a generous portion of their book value. And if they're trying to preserve book value right now, you got to preserve your bond portfolio. So you've got to shorten your duration, raise more cash, and just hope that inflation doesn't rise, because it can really kill a balance sheet.
Well, that's exactly what I was trying to get at with the question, to understand then the sort of net effect, given Berkshire's positioning, given Markel's positioning, if interest rates were to rise, on the 30-year to, let's say, 5% tomorrow, what would that do to the book value, given the way they've positioned themselves? Net, it would be a negative?
Oh, it would be a negative, for the existing bonds in the portfolio. We would hope that the stock portfolio would offset, that somehow this will enlighten, investors to see higher return potential, elsewhere. But these insurance companies right now, Berkshire, Markel, even Fairfax and Toronto and many others, they see the handwriting on the wall. They're avoiding bonds where they can, because they know the detrimental impact that rising rates are going to have. They are swinging into equities where they can. They are buying high dividend paying securities, stock securities, rather than owning bonds, because that's a better place for them to have their money right now. And they're protecting and hedging their portfolio that way. And I think that is just the sensible, rational way to do it. And they have the freedom to do it. A lot of insurance companies still have to maintain almost entirely bond portfolios to protect their insurance claims. But because Berkshire and Markel and other companies like that have compounded book value at such high rates, they built up a tremendous amount of excess capital. And they can put that excess capital to work in stocks and other type of private equity ventures, where a lot of the mainline insurance companies cannot.
Just a couple of questions here. I'm curious, what's your take on the fair value of Cracker Barrel? You mentioned the run-up in the share price there, and then relative sizes of the investment in Cracker Barrel relative to the other assets at Big Laurie, just to get a sense of the upside potential.
Well, to give you a sense of what Cracker Barrel's worth, it comes down to what your investment thesis in. If you're looking at it as basically just a very passive investment, you would look at Cracker Barrel right now priced at maybe 19 times earnings and say, well, that's a little bit high for a restaurant. But a lot of restaurant stocks in the United States have had a very nice cyclical rebound in the last 18, 24 months, and that's pushed up the price. I think what Big Laurie is looking at is kind of its investment value as a private equity holding, and the fact that he could get in there and remanage that company and get higher profits out of it than that company's capable of getting right now. And poor management is leading to a lot of the problems there. There are things you can do with CapEx. There are things you can do with refranchising. There are things you can do with a little bit of cost cutting, repricing your menu. Those are things he's thinking about, and that's what makes him a little different than a typical fund manager who's not looking at the internals of a company and saying, I want to get in there and improve it over and above. I'm just going to take this company as it is at 19 times earnings. Because you might look at Cracker Barrel right now and say, it's probably fairly valued, if not a little overvalued. But I think he's still looking at getting in on the inside and extracting a lot more value and making this company worth, what people would not believe it is worth at this point.
And just on the point of the relative size, so the Cracker Barrel value relative to how you see the value of the other assets at Big Laurie?
Well, I think you could look at the Cracker Barrel holding right now as constituting, I think, about 60% of the market cap of Big Laurie Holdings. So you subtract that out, and that says that the Steak and Shake Holdings and the franchise there and the franchise of Western Sizzlin is only being valued at the other 40%. And you look at just the Steak and Shake cash flow capabilities, you can see that the market's only valuing Steak and Shake and some of those other things at a couple times cash flow. So that tells you there's a valuation discrepancy going on. That the stock is not giving credit to not only the appreciation of the Cracker Barrel stock over the last year and a half, but not giving any appreciation at all to Steak and Shake, which right now could be spun out and at a much higher value than what we're seeing in the market right now. So this is why I think Big Laurie is on the tune of $60 to maybe $100 a share undervalued based on what the net asset value is at the moment.
Well, really want to thank you, Tim, for sharing your thoughts on the Berkshire meeting, as well as some of these Berkshire lookalikes out there that perhaps are worth taking a closer look for any investor interested in these types of models. Is there anything we haven't discussed that you feel is important to either understanding the Berkshire better, or when it comes to these Berkshire lookalikes?
Well, if you're an investor and you're focusing on them, you got to look at them as compounding machines, and you've got to focus first and foremost on the growth, and then you've got to focus on the culture and the temperament of the managers running these types of companies. Because if there's a common thread between the Big Lauries and the Markells and the Berkshires and the Fairfax and the Brookfield Asset Management, they all have this DNA wired within the CEOs or the founders or the founding families of just discipline and focusing on long-term growth. If managers are doing that and they're allocating capital very objectively and rationally and taking advantage of opportunities in the market and not just willy-nilly spending cash, you've got the possibility of a great compounding machine, because they're all in markets that are growing at GDP plus a few percentage points, and then you've got this little extra kicker of leverage. It's not debt leverage, but in the case of Berkshire and these other insurance companies, it's float. And float becomes its own kind of secret sauce leverage that allows you to grow your book value at much faster rates in the market in general. And if these companies can continue doing what they're doing and maintain their culture and keep that culture going, even in the case of Berkshire, once Buffett's gone, if you keep that culture going, you're going to maintain that compounding machine. So culture, management, discipline, temperament, those are the things that really are the secret sauces of these types of businesses.
And actually, that brings up an interesting point about the mechanics of these holding, these structures, and certainly going after businesses, acquiring control. And there's certain dynamics there and skills, but that something extra, that really, that spirit, if you will, the culture. Would you just venture sort of to tell us a bit about how you assess that at these Berkshire lookalikes? Who's got that something that I think Charlie Munger talks about rationality as really the key thing for investors. Who has that displayed in a way where you really feel that they're not just in a way a Berkshire lookalike that has the skills, the structure, but is really has that rationality to take it forward for eternity, if you will.
I think you're looking at capital allocation first and foremost, and the evidence of capital allocation. None of these companies really pay dividends. They don't want to, because they're getting high returns on their capital. If they start paying dividends when they're still getting high returns, you've got to question what they're doing. Are they trying to appease Wall Street? Now, you look at their pattern of share buybacks. Are they doing them at all? And when are they doing them? You take a company like Fairfax in Toronto, they buy back stock when it falls below book value. And then when it gets way above book value, they issue shares. They've been doing that to increase book value. It's another tool they use. Berkshire Hathaway will buy back shares if the stock gets near book value or beneath what they think is intrinsic value. If they're waiting for those types of moments to buy back shares, that tells you something about rationality. We have a lot of companies that claim to aspire to be Berkshire lookalikes, but when I see them buying back stock at 30 times earnings, it tells me no, they're not really following the discipline. If they're making stupid acquisitions and paying too much for acquisitions and trying to build value just by accreting one company on top of another, but always paying a high price, they're not going to get the rates of return. And it's going to show up eventually in terms of impairment charges. It's going to show up in terms of slowdown of the company. It's going to show up in terms of one day the earnings are going to crash of the company. And these are things that just haven't happened to companies like Markel or Berkshire or Brookfield Asset. And that tells you you've got just well-disciplined managers in there. And on the insurance front, what you want to look for is when are they writing premiums in new business and when are they not? If markets are what they call hard in the insurance market and premium prices are going up, you want to be able to have the capital and zip in there and increase your premiums and your policies in force by 20% in a certain year. And conversely, if you have a soft market and premiums are falling because there's just too much competition and too many folks getting into that business, you want to see that these companies are throttling back. They're letting these policies roll off and they're not renewing them. And they're willing to take a hit on the revenues and the operating profits and their combined ratios for a couple years just to wait for better markets. And if you see that, that's the best evidence you can get that these companies are disciplined and they're putting capital to work when you should put it to work, when times are bad. And that's what that ultimately comes down to. When blood is in the street, if you've got the staying power and put money to work, you're going to get a higher return than people who don't. And we know it's just human nature to want to put money to work at the top. Everybody does. Investors do it. Corporate CEOs do it. They're flush with cash, at the wrong time of the business cycle all the time, and that's when they go out and make acquisitions. The best managers wait until hard times. They wait until the phone rings and, from a desperate seller says, will you pick up my business? Will you pick up my portfolio? Here's what you can take it off my hands for this. Please take it off my hands for this. And they're waiting there, and they have the discipline to say, yes, I can do it. And conversely, when times are really good, they will just walk away for a couple of years and not buy anything. If you see a steady pattern of that within these companies, you got something really, really nice working in your favor.
And we've talked about the entities themselves, the Berkshires, the Fairfax, the Markels of the world. Where do you see, perhaps on that note of having that discipline on the operational level when it comes to some other companies, perhaps in your portfolio or just in general, who are some of the CEOs that you really admire on that front?
Well, to get the type of growth you're talking about requires acquisitions. Whether you're an insurance company or Berkshire or even industrial or building a conglomerate, it all is based on acquisitions that are made wisely. And there aren't too many companies outside of insurance that have done it. There aren't too many companies in financial services that have done it to speak of. There are a couple of companies in the industrial space that I think have an outstanding track record of making acquisitions and building book value at very high rates. One of them is Danaher, founded by the Rales brothers. It's a conglomeration of dozens and dozens of smaller niche manufacturers that were bought and improved. Because as soon as Danaher buys a company, they put in something called the Danaher Business System, which is, think of it like a total quality program to improve the operations and the sales prospects and the inventory management of all these companies they purchase. And they are able to extract 300 to 500 basis point margin improvements on all their businesses within a few years. And this is one way to compound value. Now, a few years ago, the Rales brothers took a company public called Colfax, which is almost like a Danaher look-alike, but Danaher number 2, or son of Danaher. And this is another little niche industrial businesses. They're mostly into welding and tools and industrial process equipment. And they have been compounding book value at a pretty decent rate in the few years that they've been in business. And they just completed a very large acquisition of a UK company called Charter International, which is, overnight quadrupled their revenues. But if they start extracting better margins out of this company in the next couple of years, we're going to see some fabulous earnings growth out of them. But, I'm not going to bet against the Rales brothers. They've had a long track record of building value with manufacturers through Danaher. They're doing the same thing with Colfax now. We're going to watch that one very carefully because this has the ability to be a nice compounding machine, at least in the industrial space.
Well, I want to thank you so much for your time here today, sharing your insights as we all leave Omaha to our destinations. I'm just curious to hear from you. What is perhaps the one key takeaway that you take from this year's meeting that you can really apply in your day-to-day work at Sanibel?
Well, more and more I learn this value of just having good managements. It's not something that I would have thought about 20 years ago when I first got in this business, when you wanted to just analyze everything in terms of spreadsheet metrics and finding good companies that way. It really focuses on management and the team that's below management and the culture that's built up. And Berkshire exemplifies this. They're at the top of the mountain in terms of giving us the direction and being the guiding light for how to run a successful business. And every time I leave Omaha, I just think about, how do I find another Berkshire? You know, are there other Berkshires? Who's aspiring to be Berkshire? Who can do it? Who has the ability to do it? Who's got the management team in place? You know, because Berkshire has set the mold that now I want a lot of the investments in my clients' portfolios to look like. So I'm looking for more Berkshires in my future, and you know, I think that every year I get a little more wise in identifying the tools that allow me to find these Berkshires.
Well, on that note, we're going to leave it there. Timothy, I want to thank you again so much for sharing your time and insights with our audience.